Hi there, and welcome to our video on put credit spread and call credit spread. Today, we're going to take a deep dive into what these options trading strategies are and how they work, specifically for beginners. Let us have a deep understanding of put credit spread. A put credit spread is a popular options trading strategy that involves selling a put option with a higher strike price while simultaneously buying a put option with a lower strike price. This strategy is executed for a net credit, which means that the premium received from selling the higher strike put is greater than the premium paid for buying the lower strike put. The primary goal of a put credit spread is to take advantage of a bullish or neutral outlook on the underlying asset. By selling a put option with a higher strike price, the trader collects a premium, essentially receiving money up front. At the same time, the trader buys a put option with a lower strike price as a protective measure, limiting the potential loss. One of the key advantages of a put credit spread is its defined risk. The risk is limited to the difference between the strike prices minus the net credit received. This limited risk exposure provides traders with more control over their potential losses. Overall, a put credit spread provides an opportunity to generate income while managing risk. It benefits from the passage of time, as both options decay in value over time. By selecting appropriate strike prices and managing the trade effectively, traders can potentially achieve profitable results with this strategy. Example of put credit spread. Let's assume an investor is analyzing the stock of company ABC, which is currently trading at $50 per share. The investor believes that the stock price will either remain stable or experience a slight increase over the next month. Based on this outlook, the investor decides to implement a put credit spread strategy. The investor sells a put option with a strike price of $45, expiring in 1 month, for a premium of $2 per share. Simultaneously, the investor buys a put option with a strike price of $40, expiring in 1 month, for a premium of $1 per share. By selling the higher strike put option for a higher premium and buying the lower strike put option for a lower premium, the investor generates a net credit of $1 per share, $2 premium received, $1 premium paid. This credit is immediately added to the investor's account upon establishing the spread. Now let's consider the potential outcomes at expiration. 1. If the stock price remains above $45 at expiration, both options expire worthless. The investor keeps the entire credit of $1 per share as profit. This represents the maximum profit potential for the put credit spread. 2. If the stock price falls below $45 but remains above $40 at expiration, the higher strike put option that was sold will be out of the money, and the investor will retain the entire credit received. The put option bought at the lower strike price also expires worthless. In this case, the investor's maximum loss is limited to the initial credit of $1 per share. 3. If the stock price falls below $40 at expiration, both options are in the money. The sold put option will be exercised, and the investor will be obligated to buy shares at $45. At the same time, the bought put option can be exercised, allowing the investor to sell shares at $40. The difference between the strike prices represents the maximum loss for the investor. The break-even point for a put credit spread is the higher strike price, $45 in this example, plus the initial credit, $1. Therefore, the break-even point in this case is $46. Now let's dive deep into a detailed understanding of call credit spread. A credit spread is a financial options strategy that involves simultaneously buying and selling options contracts on the same underlying asset with different strike prices. It is called a credit spread because the strategy typically generates a net credit or income when the options are initially established. In a credit spread, an investor sells or writes an option contract with a lower strike price and buys, or buys back, an option contract with a higher strike price. The options involved in the spread can be either call options or put options, but for the purpose of this explanation, let's focus on call credit spreads. When setting up a call credit spread, the investor sells a call option with a lower strike price and simultaneously buys a call option with a higher strike price. The options usually have the same expiration date and represent the same number of shares or units of the underlying asset. Overall, a call credit spread offers a limited risk, limited reward strategy that allows investors to profit from a modest decline or a sideways movement in the price of the underlying asset. It provides an income-generating opportunity while maintaining a defined risk profile, making it a popular strategy for options traders. Example of call credit spread. Let's say an investor is analyzing the stock of company XYZ, which is currently trading at $100 per share. The investor believes that the stock price will either remain relatively stable or decline slightly over the next month. Based on this outlook, the investor decides to implement a call credit spread strategy. The investor sells a call option with a strike price of $110, expiring in 1 month, for a premium of $2 per share. Simultaneously, the investor buys a call option with a strike price of $115, expiring in 1 month, for a premium of $1 per share. By selling the lower strike call option for a higher premium and buying the higher strike call option for a lower premium, the investor generates a net credit of $1 per share, $2 premium received, $1 premium paid. This credit is immediately added to the investor's account upon establishing the spread. Now let's consider the potential outcomes at expiration. 1. If the stock price remains below $110 at expiration, both options expire worthless. The investor gets to keep the entire credit of $1 per share as profit. This is the maximum profit potential for the call credit spread. 2. If the stock price rises above $110 but remains below $115 at expiration, the lower strike call option that was sold will be exercised by the buyer. The investor will be obligated to sell shares of company XYZ at the $110 strike price. However, the loss from this obligation is offset by the premium received, resulting in a reduced net loss. The maximum loss is the difference between the strike prices $115, $110 equals $5, minus the initial credit of $1, resulting in a maximum loss of $4 per share. 3. If the stock price rises above $115 at expiration, both options are in the money. The sold call option will be exercised, and the investor will be obligated to sell shares at $110. The bought call option will be exercised, allowing the investor to buy shares at $115. As a result, the investor will face a maximum loss of $5 per share, which is the difference between the strike prices. It's important to note that the break-even point for a call credit spread is the lower strike price, $110 in this example, minus the initial credit, $1. Therefore, the break-even point in this case is $109. In conclusion, both put credit spread and call credit spread are option strategies used by traders to generate income and manage risk. A put credit spread involves selling a put option with a higher strike price and buying a put option with a lower strike price, while a call credit spread involves selling a call option with a lower strike price and buying a call option with a higher strike price. However, as with any investment strategy, it's important to do your research and consult with a financial advisor before making any decisions. We hope you found this video informative, and we encourage you to like, subscribe, and leave a comment below with any questions or feedback. Thank you for watching, and we look forward to bringing you more informative content in the future. And we'll see you in the next video.